right, so in this video, what I want to talk about are a few different tax codes that pertain to life insurance and why they're important. So the first tax code I'm going to go over is 7702A. And basically, what this part of the tax code talks about is how it's a rule that limits how much you can put into a life insurance policy so that it does not turn into what's called a MEC or a modified endowment contract. So for 7702A, we'll call this the MEC test. And why the IRS has this is because think of think of your cash value life insurance policy if it's set up the right way. It's a tax-free savings account, and what they don't want you to do is dump in too much money into that policy up front because what that's gonna be or turn into in the eyes of the IRS is, okay, this is no longer being treated as life insurance. This is now a taxable investment, the modified endowment contract. It's really an investment with an insurance wrapper. So that's what 7702A really outlines is that if you fund your policy too aggressively, it's going to turn into a MAC or a modified endowment contract. It's no longer life insurance. It's going to lose key tax advantages. So that's what 7702A refers to. Now, the next tax code I want to go over is 101A, and this is all about the death benefit being tax free. So what 101A talks about is when the insured dies on the life insurance policy, the death benefit's going to be paid out to the beneficiary or beneficiary's income tax free. So that's really important. So 101A is all about the tax free death benefit. Death benefit. Okay. And then the last tax code I'm going to go over today is 72E. So 72E is all about how your cash value is taxed inside of your life insurance policy. So there's a couple different things to go over. So number one is how your policy is taxed if you do not have a MEC. So if your policy is still a life insurance policy, it's not a MEC. The way that your cash value is taxed is based off of FIFO, which is first in, first out. So what you can do with this is basically you can pull out your basis tax free. So if I had 200, let's say I put in $100,000 and my cash value grew to $200,000. If I were to withdraw $100,000 from my policy, and I'm not suggesting to do this, just for the example, if I did withdraw 100,000, I'm not going to be taxed on it because it's going to withdraw my basis first. Now, what will be taxed is if I decided to withdraw any money above my basis, so any of the gains on the policy, if I were to withdraw them, I'm going to be taxed on the gains. Now, a way around getting taxed on the gains, and I have other videos on this, and there's tons of other videos online explaining this, is if I borrow against the cash value, I'm not withdrawing the gains, I'm borrowing against it. That's a way I can get around paying taxes. So that's what 72E defines for non-mex. Now for mex, it changes up a little bit and it basically outlines that if you were to, let's say, withdraw money from your mec, it had a different tax treatment. So it's no longer FIFO, it turns into LIFO, which is last in, first out. So essentially what that means, if I had $200,000, let's say, just like the other example, when I withdraw money from it, the gains are pulled out first. So if I withdraw $100,000, well, I'm going to be withdrawing the $100,000 of gains first before I get to my cost basis. So I'm going to be taxed on that $100,000. And also, too, with a MEC, the way you're taxed is similar to a 401k. So you're taxed on the gains, and there's also a 10% penalty if you're under the age of 59 and a half. So that's something, really important to be aware of. And another thing with a Mac, and the last thing I'm going to touch on in this video is even if you borrow against your policy, if you borrow against your policy and it's a Mac, you're still going to be taxed. So that's something really, really important to be aware of. And especially if you're planning to use your policy for the tax-free nature of it, the agent that's helping you set up the policy needs to know what they're doing to make sure your policy does not mech at any point in time throughout the lifetime of the contract because you're going to lose all of those tax benefits. So 72E, to recap, is how your call it CV, your cash value is taxed. So let me know if you have any questions on what I went over in this video today. If you do, drop them in the comments below. Outside of that, I hope this video helped, and I'll see you in the next video.